Morning, everybody. It's 10:30, so I will get started. In case I haven't spoken to you before, my name is John Bloomfield from Bloomfield Financial, independent financial advisors in the northeast of England. Most people on the call, I think, know us in some capacity. This morning we're going to be discussing offset mortgages. I'm going to explain how they work and try to teach you how to evaluate whether they're a good idea for you or not. So in a second, I'll share my screen. After the webinar is over, I will upload a copy of this webinar to the internet. I will actually add it to our YouTube channel rather than to the usual Vimeo link, where we've been adding some of our past webinars as well, which they'll stay there until they become invalid and then we take them down. So I will share my screen and we will crack on. So assuming you can see my screen there, please pop up your thumbs up or whatever, or some sort of reaction. Let me know if you can see it, or comment in the chat box if you can't. But anyway, offset mortgages. So the usual webinar housekeeping. Please try to stay muted so everyone can hear, so there's not multiple voices. I have my speakers turned off to avoid any feedback loops. So if you say something, I won't actually hear you anyway. So the chat or the reaction boxes are the way to catch my attention if you need to. Questions can answer in the Q&A box. It can't be seen by others on the call, as you can't see who else is on the call. I'll get to them at the end if they're not being covered in the actual webinar. And Dee, our main mortgage advisor, is on the call as well. She's in the chat room, so she might pick up the questions and answers as we go through. The recording will be available before the end of the day. It might be only available for a limited time. As I said, we had been putting these onto our Vimeo, so you can take them down easily, and then only putting them onto YouTube if they seemed like they would have a shelf life. So we'll try to take things down from there if they come out of date. The webinar is educational and not personal advice. I should say, though, if anybody is watching this on YouTube as a recording later, we try to take them down if they come out of date, but be mindful of when this webinar was presented, because we might forget or not realise that it's still up there. And again, the webinar is educational and not personal advice. Standard mortgage warnings. Remember, if you have a mortgage on a property and you don't keep the payments, they're going to take it off you. And from our perspective, we give our clients the option to pay for mortgage advice by fee rather than commission where they choose to. And the FCA does not regulate all mortgages. So they don't cover certain types of buy-to-let, commercial mortgages, and that sort of thing. So on with the main content of the webinar. So we're going to go over how offset mortgages work, including some work examples to see the effect. What the tax benefits of offsetting are for different tax brackets. I'm going to stick to English examples on this, but the same sort of principles apply in Scotland. And we'll go through some worked examples of how the maths goes, and then we'll look at a summary with a Q&A. When I went through this as well, though, I did notice something about how providers market the offset mortgages. That can be a little bit misleading, probably a bit strong, but not really the way that I think you should look at offset mortgages. It's a little bit more nuanced than perhaps the online calculators and tools imply. So an offset mortgage is a property loan linked to a savings account. The money you have saved in the account is used to reduce the total balance you pay interest on each month. So all offset mortgages have two things. They have a savings account that receives no interest, and it's usually instant access, but doesn't always have to be. And they have a mortgage account. And interest is only charged on the amount outstanding minus the savings balance. The mortgage account can still be a fixed rate, a variable rate, or discount, etc. It doesn't matter. There can be any version of offset. They do tend to be variable rates, but they don't have to be. But the big question is why about offsets. That's sort of often overlooked. Why would anybody use one in the first place? Why would anybody be holding on to cash savings at all, rather than just paying it off the mortgage or investing it or putting it into pensions or something more long-term sensible than holding on to cash? So traditionally, people who would take an offset mortgage would be somebody who had to hold cash for short-term needs, on a regular basis. So a typical example would be somebody who knows they're always going to have a large tax bill every year to pay. So they hold the money to one side for their taxes. So they're always going to have a decent balance in their savings account that they're going to give away the tax man once a year, but they're going to top it up again next year. So they're always going to have cash on hand, and that's larger than most people would hold. So they might as well be trying to get something from that cash while they're holding on to it. The same possibly for people who are self-employed and maybe need to have a cash buffer for when business calms down, and they might have periods where they're not working so much. Another typical example is when people are planning large renovations on a property and they have a large chunk of cash that they're holding on to that's going to be paid out over stages. An offset mortgage might be a sensible option while they're doing the work, and when they've run out of the cash, they might want to move on to a more traditional mortgage later. So there's lots of reasons why people might be holding on to cash. Generally speaking, if you're not holding on to a lot of cash, you're probably going to be better off with a normal mortgage and not getting much on your savings, as it were, in normal cash savings. That's not always going to be the case. But generally, for emergency fund money, most people are only keeping 3 to 6 months of outgoings. So it's not a substantial amount in comparison to how big their mortgage is. But anyway, no, we'll chat about the whys. We'll talk about the practicalities of how it works. So in practice, so in this scenario, we've got a £100,000 mortgage and the person's got £20,000 in cash savings. So without an offset, the mortgage interest of 5% per year would be costing them £5,000, surprisingly. They're say with an offset, it would be costing them £4,000 because they would only be charged interest on £80,000 balance. So it would be 100,000 minus 20,000. They'd only be charged interest on the 80,000. But the person without an offset would have their savings. In this scenario, we imagine that they're getting 5% per year. They're getting £1,000 interest. This person's getting nothing. So overall, they're both mortgages costing both of them £4,000 because they're getting 5,000 out, but 1,000 in. They're just getting the straight 4,000. In reality, the chances of you getting the offset mortgage and getting a mortgage and a savings rate at the same rate is pretty slim. Generally speaking, the way the economy works, money borrowed is always going to be more expensive than money you save with a bank. But to keep things simple, to help people understand the whole concept, I've used the same rates quite frequently throughout these examples. It's something that you have to bear in mind is that savings interest is now taxable. It's always been taxable, but savings interest is taxable, and people do tend to forget about that unless the money's in an ISA. And generally speaking, if you're also investing for the long term, we'd recommend you use your ISA for that and not for cash savings, because capital gains tax is scarier than income tax in the long term. So what are the tax benefits of offsetting? And is it worth it for you based upon your category? So stick to the same scenario, £100,000 mortgage, £20,000 savings, and then get 5% interest on both. Now, interest on savings is taxed. If you're a basic rate taxpayer, you get your first £1,000 a year interest tax-free. If you're a high rate taxpayer, you get £500 tax-free. And if you're additional rate taxpayer, you don't get any amount tax-free. So in this scenario, we've got column width offsetting, how basic rate taxpayer would find it, high rate taxpayer, and additional rate taxpayer if they were using a standard mortgage and getting interest on their savings at 5%. So obviously with the offsetting, it's very simple. The mortgage interest is knocked down to £4,000 because they're only being charged interest on £80,000 of the mortgage. Everybody else is being charged the £5,000. There we go. There's the interest paid out on the savings. Brings them all back to the £4,000. With offsetting, there's no tax to pay because you never received any interest in the first place, and it doesn't matter what your tax category is. Basic rate taxpayer, the interest paid is under their £1,000 limit, so they don't pay any tax. The higher rate taxpayer only gets a £500 allowance, so they get paid taxed 20% on the other £500, so there was £200. The additional rate taxpayer doesn't get any allowance at all, so they get taxed at 45% on the. They get taxed at 45% on £1,000. There's a mistake in the maths there. That should be £100, not 200. So overall cost with offsetting would have been £4,000. Basic rate taxpayer £4,000. higher rate taxpayer would have been 4,100, not 4,200. And the additional rate taxpayer, 4,450. So they've paid £5,000 in interest. It's in mortgage interest, they've had £1,000 in, but they've had to pay £450 in tax. But if we double the numbers, and I almost guarantee that the higher rate taxpayer has been made incorrect because I would have just doubled them. Obviously, this is taking the basic rate taxpayer out of their savings allowance band. So with offsetting £8,000, again, the same scenario, they all get down to £8,000 in the simple terms. Now we take the tax into account. The basic rate taxpayer now has £1,000 that is going to be taxed at 20%, £200. But the higher rate taxpayer has £1,500 that is going to be taxed at 20%. So that should be £300, not £600. The additional rate taxpayer has £2,000 is going to be taxed at 45%, £900. So here, once the basic rate taxpayer gets above the £1,000, the overall cost is cheaper with offsetting. But we have to bear in mind that I've used very simple maths here with 5% interest on both the savings and the mortgage, the loan borrowing, in order to make it straightforward to understand. In reality, you're not going to get the same rate on both, so the maths is a little bit more complicated. You're going to have to work out how much return you're going to get on your savings, what the tax would be, and we'll work out what the cost would be. And I'll show you how to do that. And I've actually got a spreadsheet that I can give you a copy of if you really want at the end. Compounding is the big effect that we see when we look at the savings made through offsetting. And this is the thing that you notice when you look at all of the providers' websites, when they have the calculators to show you how offsetting works. They're looking at very long terms, 10, 20 years, things like that, to show the offsetting effect. And that's where there's a fundamental flaw, but I'll come to that after we run through the numbers. So getting £200,000 mortgage at 20%, at 5% over 20 years, the monthly payment is going to be around £1,319, depending on whether the interest is calculated on a daily, annual, or monthly rest basis, which doesn't make a difference to numbers. So remember, these are all guides. They're just rough numbers based on annual basis. Of that £1,319, £497 is going to be paying off, this is during the first year, each month what you owe. £821 is going to be the interest. And over the full 20 years of the mortgage, you're going to pay £116,778 in interest. Obviously, as the years go on, this number starts to go up and this number starts to come down because the balance on which your interest is calculated is falling each year because you're paying some money back, assuming you're on a repayment mortgage. If we looked at 40,000 off savings offset against the loan, what we see is the monthly debt payment comes up to £628, so more is being paid off, even though the payment's staying the same, less is being charged in interest, and this brings the overall cost down to £98,130 in interest across these 20 years. This wasn't supposed to load like this. It's just supposed to bring the figures in to show you what the previous totals were for comparison purposes. So this is with a 40,000 offset, bringing the balance of the loan down. But compounding works both ways. When you're saving outside of a normal account, interest being added, then the balance is going to be going up and you're going to get interest on interest. So £40,000 savings compounded at 5% after 10 years to a basic rate taxpayer would be worth £59,000, higher rate £55,000, additional rate £52,000. So they're in total interest of £19,000, £15,000, £12,000, 20 years. Obviously, the numbers just get bigger. Now, again, though, we have to bear in mind that tax rates do change. Savings allowances are actually a relatively new thing as well. So these long-term projections should always be taken with a pinch of salt. And that's the main problem with the figures, and I've seen it everywhere. When we look at things from a financial planner perspective, rather than just from pure maths, there's a couple of problems. Interest rates change. All the calculators will make an assumption that your interest rate's going to be the same for both your savings and your mortgages. For the long term, that seems very unlikely. They also make the assumption that the money you put into the savings is going to stay in the savings and that you're not going to use it at any point. Also seems unlikely. Tax rates change all the time, especially the limits, the thresholds, always being tweaked. If you live in Scotland, you'll be well aware of how different things are up there. Cash is usually a short-term thing. Most people will be badly advised to be holding large amounts of cash for the long term. So why would we look at offsetting as a long-term thing in a financial planning context? Usually it should be a way to take advantage of large sums of cash that are being held, and those bits of cash would normally be held for the shorter term. I mean, there may be scenarios where somebody needs to hold a large amount of cash for a long term, but it's quite unusual from a sensible financial planning perspective. And there are usually costs involved in setting mortgages up of all sorts, and these are often missing from the calculators. But essentially, when we're looking at whether offsetting for somebody is a good idea or not, instead of looking at the offset mortgage and the savings account as one combined thing for 20 years, I think it's better to compare them to shorter term mortgage deals, i.e. I need this cash for the next 2 years. I've got a 2-year fix and the best savings rate I can get for 2 years, which is a fairly predictable period for the interest rates. How does that compare to offsetting with the best offsetting deal I can compare, which is a bit more complicated, but it's comparing your real options rather than just the imaginary scenario of offsetting or not offsetting on one particular interest rate. So how do you go about making that evaluation? You need to get some information together. Some rules of thumbs. Usually the interest from savings is lower than the rate for borrowing. The examples of the same being for borrowings and savings that I used before is, again, as I've already said, are very unrealistic. You can't predict rates long term for either savings or borrowing, though you can fix both for a few years at a time. So if you know you're going to need the money for, you're going to hold on to that deposit amount for a year or 2 years, you can get 1 or 2 year fixed rate savings accounts. So you can predict the rate you're going to get. Obviously, you give up access when you take those accounts. The higher your tax rate, the greater your benefit generally. But couples should bear in mind, especially if you're married, if you put all your savings in the name of the person who pays the lowest tax rate, then that's how you will be taxed, generally speaking. Wouldn't necessarily recommend this for people who aren't married, because obviously the person with the money in their account could just run off and leave it. If you are married, though, it will be taken into account in the divorce settlement anyway. There's no such thing as singly owned assets, really, when it comes to separation and divorce and financial settlements. Given the above long-term calculators, and that's all I could really find online when I was researching this topic and bringing my knowledge back up to date, though lenders do promote them, and I think they promote them because bigger numbers are more compelling. So saving £800 in total cost over 3 years is a lot less attractive than 25 grand over 20 years. So in my opinion, it's better to evaluate the current year or however long you think rates will be valid for, reassess each time annually or at the end of your mortgage deal to make sure you're still getting a good deal. A lot of offset deals, you may correct me on this, but a lot of offset deals used to be without any sort of tie-in. So you can reassess them whenever the rates change. The rate goes up on either the savings or the mortgage. So how do you go about working it all out? This is going to be quite heavy, but I have the spreadsheet that I can let you have a copy of if you want, with some caveats. So for the savings account, you need to gather some information so you can make some calculations. So you need to know how much savings you've got, what interest rate you can get on it, what your tax bracket is likely to be throughout the term of the savings, because it might change. You might be retiring partway through or taking a sabbatical or whatever, and how long of a mortgage deal you're willing to tie yourself in for if you were doing savings and mortgage separately. And then to calculate, you're going to have to work out what the gross interest is, what tax would be due, the net interest, and the compounding effect on the savings account. So obviously next year's interest paid would be higher than this year's, because you get paid interest on interest. That's the beauty of compounding. So essentially you want the balance, the rate, no tax rate in the deal term that you want to consider it over, i.e. your evaluation period, multiply the balance by the rate to get the gross interest, and then work out what your tax due would be. That'll work out what your net interest is. And then do it all again with a new balance plus net interest starting at the beginning of next year. It's every year that you're willing to consider this for the number of terms. So it's a bit of a complex pain, really. And you can't use the standard compounding calculation in Excel because it won't take the tax into account. Then you want to look for the best non-offset mortgage you can get. Again, you want to know what your mortgage balance is going to be on that, interest rate, your monthly payment, the deal term. What you need to calculate what your year one interest is going to be, interest. But yeah, how much interest you're going to pay in year one, how much capital will be repaid in year one, so that you can establish next year's balance, and then you can calculate the interest for year two, and then so on, and for however many years that you need to compare. Then you just want the best offset mortgage, and you need basically all the same figures, but except you need the mortgage balance and the savings balance because you want to calculate the interest on the difference between the two. And again, you just go through the compounding process. And then when you've got all these figures calculated, you want to compare non-offset mortgage plus savings versus offset mortgage. So the total cost of mortgage interest minus the after-tax interest received on savings to work out the total cost would have been for you in servicing that. And the offset mortgage is simply the total cost of interest over the DIC period. My typing has been brilliant, this one. So as I said, I have a spreadsheet that I've made. This isn't a simple process. Obviously, a mortgage advisor, if you've got significant savings, should be looking at this for you. And if you work it out, so you don't need to worry about it yourself. But I've made this spreadsheet, and you can have a copy of it. But the caveat is, you can't rely on it. I don't take responsibility for anything that you can you see the spreadsheet? It's on my screen, I think. I don't take responsibility for anything you do off the back of it, and I knocked this up yesterday quite quickly, so it is potential for errors. So I've left all the formulas open so that you can see exactly how the calculations have been made. So the spreadsheet is fairly simple. Just bear in mind all the caveats. So to start, you just go to the savings page, key in how much savings you've got, select your tax bracket, pop in whatever interest rate you can get, and whatever term you're looking at. Then you get your non-offset mortgage figures, how much you're borrowing, what the interest rate is, what the monthly payment is that you've managed to get a quote for, any setup fees, exit fees. When we say exit fees, we're not talking about penalties. Talking about when you come to the end of a deal and you say with the Halifax, you fit 2-year fixed over and you're going to move over to Santander, you'll often have a fee to pay to exit the mortgage. Admin fee like 195, 250. You shouldn't ignore those because they have to be paid at the end of the day. And the deal period, which is carried through from the savings tab. And again, do the same for the offset mortgage, except put the savings balance in, and it'll calculate, pull the date through, again, put the fees in, the payment that you're going to be making on that deal, and it'll calculate the total interest cost over the deal period. It was pulling this information from these pages here, so that's the current tax rates, creating an interest schedule for savings, one for the offset and one for the non-offset. I've got them locked just so that people don't make a mess of them, but you should be able to unlock them. But it'll show you all the formulas that are in there. They're not hidden, they're not a secret, so you can work out whether there's a mistake in there and double check all your figures. There are a few calculators online you can use to double check as well. The one on Money Saving Expert from Martin Lewis, that is a quite good one from the ones that I looked at. But they'll give you this overview page, which will just simply show mortgage plus savings, total interest earned after tax, total interest and fees for the mortgage. So that's your net position. And again, the offset mortgage is just simply how much interest is being saved. So if you want a copy of that, just drop us an email to office@bloomfieldfinancial.co.uk and I will send it over to you, or somebody will. So past webinars, we have been putting our past webinars up on our YouTube channel. We weren't going to originally because we were worried about them going out of date and things like that, and people being confused and blaming us for things if they follow a 5-year-old webinar for something. But they're up there now, so you can go and view them up there. We will put this one up there as well. Full future webinars are listed at bloomfieldfinancial.co.uk. That's the address of our YouTube channel. I'll pop it in the follow-up email with the link, as it were. We have virtually no subscribers. It's a very sad-looking little page, and I wouldn't expect it to be anything else because we don't do any scaremongering on there whatsoever. But if you feel like taking pity on us and giving it a subscribe or a like or a comment on any videos, then all pity is gratefully received. And that's it really, unless there's any Q&A. So I'll have a look at the box. If you want to book an appointment with Dee, who is our primary mortgage advisor, then feel free to book an initial chat online. QR code to scan if you're sat in front of a PC and have a quick look, see if there's anything in the Q&A. And the Q&A is empty, which generally means, means one of two things, doesn't it, really? Either that was so complicated and thrown at you so fast that you're crying into your hands, or it was all beautifully explained and you've got no issues with it whatsoever. But either way, thank you very much for your time, and I'll drop you an email later on today with the link to the upload.